But this morning I want to chat about something a little different. And I'm going to need your input. All right? So if you had to pick something that has happened, maybe it's 2 things, 3 things, 4 things, whatever it happens to be, something that has happened with a lender that has caused financing to run into a snag. It might have been something you heard about on one of your listings. It might have been something that happened with one of your buyers. And it doesn't have to be something that was so terrible that the deal fell apart. Doesn't mean that. But you may have heard something that said, we ran into a snag with this, or we ran into a snag with this. What are 1 or 2 or 3 of the snags that you heard about? Give you one other hint. And this is not a test. I'm just trying to get some feedback. But one other thing to think about, it doesn't have to be just the buyer's credit. It could be employment. It could be anything. Could even be the house, the collateral. So what are those things that you've experienced, whether it's a listing that you've heard from the buyer's agent, or that all of a sudden something's gone wrong, or maybe something that you've had with a buyer, that's one of your buyers, that something's gone haywire?
Delaying employment verification until kind of the last hour and finding out they weren't as gainfully employed as they had
implied
they were.
Okay, before we go on, anybody else have that happen? Employment verification at the last minute, finding out they're not as gainfully employed. Why do you think something like that might pop up? Give me some thoughts. Why could that pop up the week before closing or the day before closing? Why would that happen?
Underwriting final checks.
Underwriting final checks is a big one, Jay. Thank you. Most lenders today will verify employment just with a phone call, nothing more than that, usually somewhere within the last 48 hours before closing. And again, it's not an employment verification. That particular one is nothing more than a pickup and a phone call that says, does Greg, can I speak to Greg Janicki? Well, he's not available right now, but he's here. Okay, fine, thank you. Click. That means he still works where he said he did, or where the loan said that he did. That's one thing, yes. Where else why else would an employment verification fall apart at the last minute? Why else might that happen?
This particular one was...
I'm sorry?
This particular one was, she'd come with a lender that was a personal friend. I guess they just didn't do any kind of check.
Okay, and that's a big one. The lender just didn't bother doing the homework that they should have done on the front end to make sure that the person has got an accurate and completed employment verification. And unfortunately, that happens. There are lenders out there who are they either forget, they're lazy, they're not on top of it, they're not organized, and all of a sudden you get down 2 weeks or a week or 3 days before closing to find out that the employment verification is not where you need it to be. Why else could it be? Because this is a big one. I'm not surprised it came up the first one, because it is a big one that happens.
They could have an employment change between the time they apply.
Employment could have changed. Now, I will give you the one that happens to us more frequently than any of the other ones. The one that happens to us more frequently is we can't get it from the employer. Now, many of your big companies, mid-sized companies, big companies today, they use third-party verification. You might have heard of something called work number. The employee gives us a number, we contact work number, they give us the employment verification. As long as it jives with the paychecks and W-2s, we're done. It's that simple. And that is a lot of what we see today. But what if it's a small company and they don't have that? So then what we have to do is the old-fashioned way. We have to send an employment verification, a verification of employment form to somebody at the company, not the employee, and not the employee's father or mother. We got to send it to somebody in the company that has to fill out an employment verification. Now, I can't speak for every lender. I can tell you what we do. Brandy and Courtney are outstanding at this. They actually take the PDF and they highlight, like there's a full page of things. They highlight all the numbers that have to be filled out. Now, they can't tell them what to put in there. They just fill it. You got to fill in box number 15. You got to fill in box number 16. You got to fill in box number 3. Fill it all out. I'm not exaggerating with this number. A minimum of 1/3 of those come back wrong. They've either got incorrect information, or here's what happens. One of the things they typically ask for the last 2 years or 1 year, depending on what the requirement is, of what their income was last year. Now, we've got the W-2. And you'd think the employer had the W-2. And we look at their verification of employment, we look at our W-2, and they don't match. That's a problem. So what happens then? Now, we have to get with the employer. Now, this is a small company. This is not a big company, because the big companies oftentimes use work numbers. Now we're using a small company. Well, if you're in a small company, and I pick up the phone and I call Mike Pruitt, and I say, could he please give me Worrell's income? Mike is thinking, are you serious with me? Do you know how much I have to do? Call Karen. Now I call Karen. Karen's busy. Karen says, well, wait a minute once. What do you have in, and this goes back and forth and back and forth and back and forth. Next thing you know, we're 8 days before closing and we still don't have the verification of employment correct. And we've been working on it for 2 or 3 weeks. So that can be a problem. That's why verifications of employment can run to the end, assuming the mortgage company is on top of their game, doing all the things leading up to it so that it doesn't become a problem. Could you imagine not either requesting that document or dealing with that document and starting to deal with that document 7 days before closing? You're not going to close on time. It's not going to happen. So that is one. Okay, so employment verifications can potentially be a snag. What other snags have you experienced, whether you're on the listing side or the buying side, that something didn't go right on the lending side? That it, again, may not be a blow up, but may have been something that hesitated. What happens? What kind of things can happen?
I had a client wait to pull the money out, he wanted for the down payment and stuff. He was gonna pull it out of the stock market, but the market kept going down, so he kept stalling, and then eventually got down to where the lender was like, if you don't pull it, we're not gonna do it for close.
Okay, thank you, because that's exactly what happens. I mean, people will sometimes wait too long to get the money that's in the account. Now, if somebody's taking all their money out of investments, Kagan, like you just said, I mean, they're taking money out, that can be a problem, because with the way the stock market's gone down, they were anticipating they had 100,000 in there, now they have 60,000 or less in there, and it's like, oh man, that's a big problem. But there's a second part of that. Has anybody else experienced assets not coming together at the last minute? Anybody else experienced that? No? You have?
Yeah, I don't remember exactly what the issue is, but they ended up having to do cash.
They ended up having to what?
Pay cash instead of...
Oh my gosh, they ended up having to pay cash for the house. Ooh,
Yeah, it was
okay.
very
Here are the asset situations that can occur. The one thing is, people wait too long sometimes to put the money in. Anybody ever have a client that used gift money?
Seasoning. Oh, that
Yep.
happened in my situation.
Yeah, gift money. Mom and dad are going to gift money, and what happens if you're going to gift that money? There's very specific ways of gifting that money. And one of them is not to give them what? Don't give the gift in what form? Cash. Thank you. We can't verify cash. Another thing, if it's a conventional loan and mom and dad transfer, hey, we do business at Wells, our kids do business at Wells, we're just going to transfer $50,000 to the kids. Don't do that, mom and dad. Because then Greg has to get on the phone with mom and dad. And I have to say, now look, that's okay that you put the money there, but because you didn't wire it, or because you didn't write them a personal check, you now have to give me 1 month's bank statement from the account that you did that. Now think about this. Mom and dad, how many parents are just, oh, no problem, I'll just send you, ain't gonna happen. So there's very specific ways on conventional loans that you can give the money, and then we're not gonna get into your business. Now FHA is a totally different story. There we have to get a 1 month statement. We know about that up front and we deal with it. But assets can be a big deal. The other thing that happens with assets is that people's accounts, when I look at the account, I usually get a month bank statement up front. Then you get the contract go binding. Then Michelle, my wife, she turns around and she says, I need 2 current months. So Greg did this back in April and you gave him the March statement, but now we're closing in August, so I've got to have June and July. So we look at June and July, and one of the questions I always ask is, have you changed anything in your assets? Well, no. Well, then Michelle gets June and July and looks at it and says, wait a minute once, where's the money? Where's the money? Where'd it go? And it's not there. And we have to find out, where did they get the money? Where did they do with the money? What happened to it? Or they said, oh, don't worry, we're going to have the money in our account. Well, okay, how is it going to get into your account? Where is it coming from? One source that everybody uses a lot today are 401ks. If you've got a client that's using 401k money, advise them up front to start the process ASAP. Do not hesitate. They don't have to do it before they get a contract. Just once you get a contract, get the process started. All right? Okay. What else can go wrong? Verification of employment, not having assets all dotted. What else? What are some other things that you've experienced that have got in the way of, having everything just run smoothly?
DTI thrown off?
I'm sorry?
I'm sorry. Go ahead.
The new construction loan that I had that closed a year or so ago, and we had to use we used the lender.
Right, the builder's lender. Mhm.
And it came back, she had to put down more than originally advised, and it was because of the prepaids, and then you helped us with that with the aggregate credit. They didn't have all of that, and it was significant.
What Jay is talking about is that when you get down to a closing, hopefully the lender is preparing people up front for how much money they're going to have when they arrive at closing. And most people, the down payment is generally pretty easy to figure out. If the lender's accurate, a 5% down payment on a $400,000 home is $20,000. That's not complicated math. But where it does get complicated is, what are you going to have for closing expenses? Now, I always use the term closing expenses, but in our industry, real estate and mortgages, they typically don't use the word closing expenses. They call them closing costs. Well, closing costs are only 1/3 or 1/4 of the part of what your closing expenses are. Closing expenses is closing costs, prepaids, escrows, and HOA. When you write a contract, or you are preparing a contract, HOA on the CAD, on page 2 at the very top, it says how much our initiation fee, administrative fee, and transfer fee. How much is that? What if you put in there $1,000? Because maybe it is, maybe it isn't. But you put $1,000 to make sure your seller is protected, right? Because you don't want the seller to pay it if you don't put a number in there. So you put $1,000 in there. I call that a closing expense, not a closing cost. Because the closing costs are the third-party expenses and your appraisal that are being charged by the lender. The HOA has nothing to do with the lender, but it's an expense at closing, right? So in Jay's case, what happened is they underestimated, pretty significantly, they underestimated the escrows and the prepaids.
Actually, it was the other way. They charged her.
Oh, they charged too much for
They
it.
had no aggregate.
They didn't put in the aggregate adjustment.
Right.
Right. As a matter of fact, I've got one like that just personally. I was dealing with it this morning right now. What happens is on new construction, the way, taxes in Georgia, taxes all over the country, but taxes in Georgia, because that's where you're doing your real estate, are billed for the calendar year, and they're billed based on the condition of the property on January 1. So on January 1st, if it's just a piece of dirt, it's just a lot, regardless of the condition when the house closes in August, if it was a piece of dirt, then the county and the city are going to bill it as a piece of dirt. All right? So taxes might be $300 for the year, $400 for the year. The one I'm doing right now is down in Valdosta. There was a piece of dirt at the beginning of the year. They didn't pull any building permits until April. So the taxes the attorney estimated taxes for 2022 to be $300. Well, what happened is when I got the initial documents from my closing department and from the attorney, and this is what happened to Jay, they're showing what the taxes are, they escrowing what the taxes are going to be to the buyer based on the improved property. Well, the improved property, if it's a $400,000 property, taxes could easily be $5,000. The builder knows the game. The builder says, I am not giving you a credit toward $5,000 in property taxes because I know my taxes are only going to be $300 for the year. I owe you 7 months of that, so I'm going to owe you roughly $210. And that's what the attorney puts on there. But the buyer, unless the mortgage company knows what they're doing, the buyer now is taking $4,200, $410 a month times, well, the taxes are coming out next month, so I've got to collect 13 months of taxes. And all of a sudden, we go from only, we've got an extra in their escrow account in this example. We're going to have an extra almost $5,000 that we don't need. Well, when you've got a tight transaction like Jay had or many of us have had, you can't do that. That won't work. So those numbers have to be adjusted down. So yes, escrows can be a big deal. But again, all of that, now that's going to happen the week before closing, or maybe even the day before closing if it's not dealt with ahead of time. But that's one of those things you just want to make sure all the numbers are coming in right, where everybody scrambles. I don't know. I do this a week before closing, whether the loan's clear to close or not, so that we don't have to deal with it, because I don't want to mess with it. Jay, what were you going to say before?
I said your DTI being eroded.
DTI what?
DTI being eroded.
DTI being eroded, DTI going up because they did something foolish. All right, and believe it or not, no matter what happens, people do, they're buying a house and then they go out and do something and buy something else, and they shouldn't do that, but they do it, and that happens all too frequently. So that's one of the things you can prevent. You can say to the people, I say it to them, hopefully their lender says it to them, you say it to them, once you're getting ready to buy a house, you do not take out new credit. Well, I didn't take out new credit. They're giving me interest-free loan. They're giving me interest-free for my refrigerator. Wait a minute once. That's a new loan. That's new credit. You're putting an inquiry on your credit report. You don't want to do that. So number one is no new credit. Number two is before you go out and start spending your assets, let's wait. Let's see how much you're going to need for closing. You think you're going to buy a house for $300,000, but the one you fell in love with is $350,000, and now you need an extra $5,000 or $6,000 for closing. So that can happen. I'm surprised. One thing nobody brought up, and we're going to have to wrap up here in a minute, but one thing nobody brought up is appraisals coming in low. Has that ever happened to you? Now you're, if an appraisal comes in low, it doesn't necessarily mean the deal is dead. It simply means we now have to get a little bit creative on how we're going to do it, and all parties may have to negotiate a little bit. But it can still be done. And I think that's become part of the critical process of this, because we still have some appraisals that come in low. Now, it doesn't happen as often as it did, back in January, December, and November, but it still happens. We had one come in low. We had a VA appraisal come in low the other day. Sales price was $325,000, and the appraisal came in at $305,000. That's pretty good spread. I mean, from $325,000 to $305,000 is $20,000 spread on a $300,000 purchase, and they got it worked out, and the loan got closed. Although it did create a bit of a hairy situation for everybody involved. But when that happens, I think the key, the key thing on appraisals to me is not getting the appraisal in. It's talking to you up front. Do you anticipate that this appraisal is going to come in low? What is the chance that the contract sales price is going to be some number above what the appraisal will come in at? As long as you know that, your buyer knows that, listing agent knows that, seller knows that, and the lender knows that it might come in a little bit low. Then if it does, nobody's upset. We all know that might have happened. And if it doesn't happen, and it meets, appraisal meets contract sales price, everybody smiles. We're all happy. So the appraisal process is not about ordering that appraisal. It's about what happens when you are writing the contract. So please keep that in mind. Is your buyer putting an offer in above what you think that house might appraise for? I'm dealing with an agent right now who's totally inexperienced, not from this office, totally inexperienced. And I looked at this property that they're writing a contract on, and I called her up and I said, I just got to ask you, what do you think this property might appraise for? Because I happened to look at it and it seems like this contract's a little high. And these people don't have a lot of money. She says, Greg, I have no idea. I wanted to say, why are you in real estate? But I didn't say that. I just asked her, I said, well, is the buyer prepared that this may not come in? Well, they're hoping it does. I said, but they're going to spend money for an inspection and an appraisal. I mean, it's a small deal. It really is. And these people have very little money. They're squeaking by. As a matter of fact, what they're doing, they're having to deposit their paychecks and holding on to the money so they got money for a down payment and cover their portion of the closing costs. And they're going to spend money on an inspection and appraisal. We don't even know if it's going to come in. And we never know for sure, but gee whiz, if you've got no money, don't we have a job to do to help our client out a little bit maybe? All right. Well, thanks, guys. I appreciate it. Next week, I got an interesting topic for you.